Welcome to Askprep, your trusted companion for UPSC and IAS preparation. Today, we will discuss a critical topic in general knowledge, which is monetary policy and its components. Monetary policy serves as a key instrument for regulating a nation's economy. It is implemented by the Reserve Bank of India, RBI, to control money supply, credit flow, and interest rates in the economy. By doing so, it ensures price stability, economic growth, and financial stability, which are essential for sustainable development. For UPSC aspirants, understanding the components of monetary policy is vital as it directly relates to topics like economic governance, inflation control, and financial systems. So, without further delay, let's get started. Introduction: Monetary policy is a critical tool used by the Reserve Bank of India, RBI, to regulate the supply of money, credit, and interest rates in the economy. It plays a central role in maintaining price stability, controlling inflation, and fostering economic growth. By managing liquidity and influencing borrowing costs, monetary policy ensures that the economy remains balanced and resilient in the face of domestic and global challenges. In India, monetary policy operates under a structured framework with clearly defined objectives, including achieving an inflation target of 4%, plus or minus 2%, promoting financial stability, and supporting economic development. For aspirants preparing for the UPSC, understanding the components and significance of monetary policy is essential, as it forms the foundation of India's economic governance and decision-making process. Components of monetary policy: monetary policy operates through various tools and components categorized under quantitative and qualitative instruments. Let's explore these in detail. Quantitative instruments, general tools. Quantitative instruments are macroeconomic tools that influence the overall supply of money in the economy. These include a. Repo rate. The repo rate is the rate at which the RBI lends money to commercial banks for the short term, typically to meet liquidity shortages. Impact: a reduction in the repo rate makes borrowing cheaper for banks, encouraging them to lend more, boosting investment and consumption. Conversely, an increase in the repo rate helps control inflation by discouraging borrowing. B. Reverse repo rate. The reverse repo rate is the rate at which commercial banks park their excess funds with the RBI. Impact: it is used to absorb excess liquidity from the banking system, especially during inflationary periods. C. Cash reserve ratio. CRR. CRR is the percentage of a bank's total deposits that must be maintained as reserves with the RBI in cash form. Impact: a higher CRR reduces the funds available with banks for lending, thus controlling liquidity. Lowering CRR has the opposite effect, increasing money supply. D. Statutory Liquidity Ratio. SLR. SLR is the percentage of net demand and time liabilities, NDTL, that banks must invest in specified financial securities like government bonds. Impact: SLR helps maintain the solvency of banks and controls the credit supply in the economy. E. Open market operations, OMOs. OMOs involve the buying and selling of government securities by the RBI in the open market. Impact: purchasing securities injects liquidity into the banking system, while selling securities reduces liquidity, helping control inflation or deflation. F. Bank rate. The bank rate is the long-term rate at which the RBI lends money to commercial banks without requiring collateral. Impact: changes in the bank rate influence lending rates across the banking system, affecting credit and investment. Qualitative instruments, selective tools. Qualitative instruments are targeted measures aimed at specific sectors or purposes to influence credit flow. A. Credit rationing. The RBI may impose limits on the amount of credit banks can lend to specific sectors to avoid overexposure and ensure balanced economic growth. B. Moral suasion. This involves persuasion by the RBI to encourage banks to follow certain lending practices or refrain from activities that could harm the economy. C. Direct action. The RBI may take direct action, such as imposing penalties, to ensure compliance with its directives or discourage unhealthy banking practices. D. Margin requirements. The RBI may prescribe minimum margins for loans against specific securities. For example, if a loan is granted against gold, the borrower may need to pledge more gold to access higher credit. Liquidity Adjustment Facility, LAF. The Liquidity Adjustment Facility, LAF, is a critical operational framework introduced by the Reserve Bank of India, RBI, to manage liquidity within the banking system on a short-term basis. It serves as a tool to ensure that the money markets function efficiently and remain stable, allowing banks to adjust their liquidity positions daily. The LAF plays a pivotal role in implementing monetary policy by influencing short-term interest rates and the overall money supply. Functioning of LAF. The LAF operates through daily auctions conducted by the RBI. Banks with liquidity deficits or surpluses participate in these auctions to either borrow funds, using the repo facility, or park excess funds, using the reverse repo facility. This ensures smooth liquidity management in the banking system. For example, if there's a liquidity shortage in the system, the RBI conducts repo operations to inject money, enabling banks to meet their short-term needs. If there's excess liquidity, the RBI conducts reverse repo operations to absorb the surplus and prevent inflationary pressures. Impact of LAF, short-term liquidity management. The LAF helps banks manage their day-to-day liquidity requirements, ensuring that they can meet obligations like reserve requirements or unexpected cash flow needs. Interest rate stability. By regulating liquidity through repo and reverse repo operations, the RBI ensures that the overnight interbank lending rates remain stable. This stability in short-term rates aids in effective monetary transmission. Efficient monetary policy implementation. The LAF serves as a key instrument for the RBI to implement its monetary policy stance. For instance, during an inflationary period, the RBI may increase the repo rate to tighten liquidity, whereas during a slowdown, it may reduce the rate to stimulate credit growth and investment. Smooth monetary transmission. The LAF ensures that changes in policy rates, like repo and reverse repo, are effectively transmitted to the broader financial markets and the economy. This influences lending rates, deposit rates, and overall economic activity. Prevention of systemic risk. By addressing liquidity mismatches promptly, the LAF prevents systemic crises in the banking sector, maintaining confidence in the financial system. Significance of LAF in India's monetary system, crisis management. The LAF proved crucial during periods of financial stress, such as the 2008 global financial crisis and the COVID-19 pandemic, when the RBI used repo operations to infuse liquidity and stabilize markets. Support for economic growth. By ensuring liquidity availability, the LAF supports economic growth by enabling credit flow to productive sectors. Control of inflation. During inflationary periods, the RBI uses reverse repo operations to absorb excess liquidity and control inflation. Other components. Marginal Standing Facility, MSF, allows banks to borrow additional funds overnight from the RBI at a rate higher than the repo rate. B. Market Stabilization Scheme, MSS, involves the issuance of government bonds to absorb excess liquidity, especially during periods of heavy foreign capital inflows. In conclusion, understanding the components and significance of monetary policy is essential for comprehending India's economic governance and the mechanisms used to manage liquidity, inflation, and financial stability. For aspirants preparing for UPSC mains, a thorough understanding of monetary policy, including tools like the repo rate, reverse repo rate, and cash reserve ratio, CRR, is critical. Economy and governance are integral parts of the UPSC syllabus, and questions related to monetary policy and its impact on economic stability are frequently asked in both prelims and mains exams. A comprehensive study of monetary policy not only equips aspirants to answer examination questions effectively but also helps in developing a deeper insight into how the Reserve Bank of India, RBI, influences the nation's economy. This understanding enables aspirants to appreciate the intricate role of monetary policy in shaping India's economic trajectory and addressing macroeconomic challenges. At Askprep, we aim to bring such insights to help you prepare better for your UPSC and IAS examinations. Thank you. This is Askprep, your guide to mastering UPSC and IAS preparation. Let's decode complex topics and simplify your journey to success.